In the world of investment, change is the only constant. And today we are here to talk about a change that's been brewing for some time now, the shift away from China as the go-to market for investors. We are going to show you how to navigate this new landscape and harness the growth potential in emerging markets without being tied to China's specific risks. So why the sudden shift away from the once mighty Chinese market? Well, it's not so sudden if you have been paying attention. China, with its regulatory hurdles and geopolitical uncertainties, has lost its attractiveness for investors. Now we know what you are thinking, but doesn't China dominate traditional regional indices? You're absolutely right, but don't worry, we've got a plan for you. Enter the iShares MSCI Emerging Markets ex-China ETF, EMXC. This ETF is your ticket to a world of opportunities beyond China's borders. It's a game changer because it lets you limit your exposure to China while still enjoying the benefits of emerging markets. By excluding China from the equation, this ETF gives other emerging markets their time to shine. Think India, Taiwan, and South Korea. These countries get larger weights in the portfolio, and that's music to an investor's ears. Let's talk about some of the heavy hitters in EMXC's portfolio. TSMC, Samsung, and SK-hynix. These companies are the stars of the show, and investing in them through EMXC is like getting a front row seat to the future of technology. But it's not just about the heavy hitters, it's about the strategy. Investing in EMX China comes with a crucial advantage: reduced exposure to those China-specific risks that have been keeping investors up at night. Regulatory crackdowns, sudden policy changes, and trade tensions are all worries of the past when we are off the China train. Now let's talk returns. We all want our investments to grow, right? While EMX China strategies like EMXC have been delivering stronger returns over the long term. So not only are you avoiding the pitfalls of the Chinese market, but you are also potentially boosting your portfolio's performance. But wait, there's more. We are not asking you to just jump ship from one to another without a solid reason. Beyond China, we see better long-term growth opportunities in other major EM markets, especially South Korea. This is where the future is headed, and we want you to be on the right side of history. It's time to rethink your investment strategy. China is no longer the only game in town, and it's okay to diversify your portfolio. The iShares MSCI Emerging Markets ex-China ETF, EMXC, is your golden ticket to unlock the growth potential in emerging markets while sidestepping those China-specific risks. With larger weights on countries like India, Taiwan, and South Korea, and a history of stronger returns, EMXC is your path to a brighter investment future. So what are you waiting for? It's time to set sail towards new horizons beyond China. Next up, Jason is going to share with us more about CC Land, a China property developer focused on Hong Kong and UK. Jason, over to you.
Hello everyone, this is Jason from Global Fixed Income team. Today I would like to share an issuer called CC Land. CC Land is a local developer in Hong Kong with a focus on Hong Kong and the UK. And the company usually chooses to work with partners in the development projects to reduce the capital burden. The exposure to Chinese property market is very low, and it already impaired the carrying value of 2 Chinese property projects. Therefore, the Chinese property crisis should not be a risk to this company. On the credit side, some credit indicators deteriorate a bit, but the leverage ratio are still at a manageable level. For example, the net debt to total property investment is only 41%. The ratio shows that even if the asset value depreciates up to 50%, it will be still in a good position to allow the creditors to get back the full amount of principal, indirectly showing that the credit risk is under control. The short-term liquidity is strong as well, demonstrated by the high cash to short-term debt of 4 times. And the balance sheet structure is decent, which is far away from the Chinese property developers. The company has sufficient assets to be liquidated to repay the bond. The credit risk of the September 2025 bond is manageable, with the yield to maturity of over 12%. To get the full analysis, scan the QR code or click the link in the description below. That works for the sharing of this week. Catch us again next week for more investment ideas and updates. Thank you.